Good afternoon, everybody. This is Tom Bayer. I'm with Sikich in the Indianapolis office. Thank you all for joining us today for this webinar. We will, if you have any questions, you can certainly pass those along. We'll try to cover those at the end, but I'd like to go ahead and get started with the presentation. Today, we're going to talk about business succession, really preparing for business succession specific to the construction and real estate industry. So just a little bio. I've been with the firm a little more than 25 years. Most of my career was spent in the Central Illinois offices. I'm currently, the last 2 years, been over in the Indianapolis office. I've been doing business succession planning for better than 10 years now, and not just limited to the construction industry or real estate industry necessarily. It's really across several industry verticals. So that's a little bit about me, and I want to go ahead and get started into our discussion today. So the outline today, we're going to focus on preparing. A lot of times when I talk to groups about business succession planning, I not only cover the preparation for succession, I cover the process of exit and the planning and the issues that businesses face, and we'll touch on some of those briefly, but for the most part today, we're going to talk about what you need to do to prepare. And in doing that, we're going to go through several case studies, some experiences that we've had across the construction real estate industry. And I also want to cover ESOPs a little bit. ESOPs are gaining a lot of momentum as an option, and some of the ESOP experts that I know out there across the country have seen a real uptick in ESOPs, and so I think it's an important topic to cover, and I think that it's a difficult topic for folks to understand, and so I think the more you hear about ESOPs, the more you start to understand whether it's a good fit for your particular company. So to start, I always start with this idea that there are certain questions that you really have to answer in a transition planning process, and so I'd like to cover those at a higher level. And again, we're really going to focus on really this first question. And the first question really is the business ready? And we're going to talk about issues specific to the construction and real estate industry and the preparation for transition. And one of the things I want to emphasize is regardless of the age of the ownership group or the age of the business, this planning process is one that you really need to go through, because by going through it, you'll identify some areas of risk and some areas that you need to focus on and make a priority, because sometimes transition happens at an unexpected time. So it doesn't really matter if you're 20 years away or 5 years away from exiting the business. I think succession planning is something that probably should be on the business owner's agenda every year to review and update. So the first question is, are you ready? The second question we answer in our process is who are the successors? Sometimes the successor leader or leaders are different than the owners. For example, if you sell the business to a financial buyer, to a private equity firm, one of the things a private equity firm will want to see is that there's a strong management team in place, and they probably will take a majority position in that business, and maybe the leadership team will take a minority position in that business. But the leadership of the business will be the management team that was in place while you owned it. So it could be, and so if we translate that to a construction business, for example, it might be that you continue to own the business as more of a passive asset, and you incentivize your leadership team to run it and run it successfully, because sometimes the capital needs and the risk tolerance isn't there for the existing management team. So, and we're finding that more and more. The third question is how much? How much do the current owners need to retire or exit the business in terms of their own personal needs? And is there potentially a gap between what their assets are that they need, or what their assets they have versus what they need to retire, and what goals they have in retirement? So sometimes there's a gap there, and we need to work with the business owners to try to close that gap, right? And so it could be, adjusting expectations of what they're going to have in retirement, or it could be changing the timeline on when they exit the business. Fourth question is when. What's the timeline that the owners plan to exit and retire from the business? The timeline is important because it gives everybody some certainty, some idea, some goal in terms of when we expect that next generation to be ready to take over and potentially buy the business. So it's important to try to establish a timeline. And lastly, the last of 5 questions that we want to start to think about as owners is what next, right? What is next for us? We've spent our career building buildings or owning and developing real estate, and now we're ready to hand the baton to the next generation or sell the business outright. We need to have a plan. We need to have a plan in what life is going to look like after we leave the business, and that's really hard for a lot of business owners to wrap their heads around. And this is really what I call a soft question, but it's important because if we don't think about this, and if we don't have a plan, then it delays action. And if we delay action in terms of leaving the business, and we've got a terrific management team underneath us and they're chomping at the bit ready to take over, they get frustrated. And if they get frustrated and they have capital, they may go out and become a competitor. So we really have to think about this idea of what we're going to do next. And it's very, very hard for most of us as business owners to imagine ourselves doing something or not doing what we do every day. So, but it's an important question, and it's one that we want to bring up. We don't necessarily have the answer other than to say you need a plan. A best practice that we see and we strongly advise our clients who are engaging in the planning process is to make sure we have the right team in place, because as business becomes more complex and technology becomes more and more a part of every industry, we need that team of advisors that can really help us navigate through those issues. Each business is going to have some uniqueness to it, and so that team may be made up of more or less of advisors. We may need a tax advisor, we may need a financial advisor, we may need a legal advisor, and we may have our other bases covered, or we may need more advisors because of the industry we're in, or simply the type of business and maybe some other matters that are unique to us. We may need other advisors. So we take a team approach, and Sikich really is kind of the quarterback of the process. And clearly we can bring all of our experiences and our tax expertise to bear, and just our general business experience to bear to that team. So I want to transition here to key issues, and I've got a couple slides here. This first slide is from a CFMA article, and I think the article was earlier this year. There's a site there at the bottom, and it talks about what are really, predominantly in the construction industry, what are the key issues that you should worry about in preparing for transition. And I thought it was a good graphic, and we've added it to our presentation here today. I want to point out one topic here: end market exposure. And what that means is how diversified are you as a business to where you're not necessarily exposed to, overexposed to any one market, one industry. That could be geographic or it could be industry, so that you do have some diversification. And if you see a industry go into recession or experience a downturn, you're not overly exposed to that one industry. Many of these other ones are great points and good things to really put at the top of your list: balance sheet strength, historical and projected growth, and backlog trends. The biggest one that we probably spend the most time with is just the management strength and the leadership that's going to succeed and be able to continue successful business. So this is from CFMA magazine article. The next slide is really more our experiences and current engagements and past engagements in the construction and real estate industry. So I want to spend some time with each of these topics and drill down a little further as some topics that are important to your preparation. I think I mentioned at the beginning, but if you have any questions throughout, please send those to our staff, and we'll try to cover those at the end. They will go through those and share those, and hopefully we can cover those at the end. I think we'll probably have some time. The first issue, key employees, is a really, really important issue to business, especially in this day and age of sort of this talent shortage out there. So a very important topic, and we'll cover that in detail. Balance sheet strength, that was something you saw on the previous slide. Really important topic. Key relationships we find are extremely important in preparing. Quality of information, I want to talk a little bit about that. Innovation, technology, are we investing in the future? Are we current with the technology trends that are going on so that we can compete for the young talent, that we can be more efficient in our delivery systems, and so we can communicate with customers. And then lastly, business continuity, I think is a really important topic that you should think about, again, regardless of your proximity to an exit. Preparing for transitions about time. And one of the things that we see all too often is business owners. I just met with a local architecture firm, and the business owners were very, very close to wanting to retire within a year or two. And at that point, you really limit your options because these things take time, and this graphic is reflective of that. And I just kind of go down through it. Obviously, unexpected events you should be prepared for now, and those are really what I call low-hanging fruit. We really need to address issues of great risk to the business, and that needs to be a high priority to be done right away. If you're going to close the business and simply liquidate, suggest at least a year, and then you start to move up the spectrum to preparing for if you're going to sell the business outright. And we'll talk a little bit later about whether, we'll talk about who a likely buyer in these industries might be. And I've got some statistics on that from a recent survey. Developing an employee successor and a child in the company as the successor, you're out 3 to 5 years. And then of course, many of us have this dream of having our children come into the business and continue the family legacy. Many times, companies, bear the family name and we have great pride in that legacy, that is a longer term process that you should be starting 5 to 7 years from the 25th birthday. So it takes a lot of time, and I want to encourage everyone to spend some time, make this part of your sort of New Year's resolution, if you will, to dedicate some time and resource to reviewing and assessing your plan. And just to give you a quick case study, we worked with a GC a few years ago. They were a good-sized GC, average, probably a 5-year average revenue of about 50 million. At the time that we became involved with this particular client, they had the 2 founding owners owned majority of the stock. And they had already, which to their credit was very strategic, they'd already identified key employees which that they believed were going to be successors. They were, they had an age, they were the right age gap, if you will. In other words, they were, 15 to 20 years younger than the founders. And they had gotten 20%, around 20% of the stock to them. They had sold it to them, and it was funded by S corporation dividends. So they sold them the stock and took a note, and then as dividends were distributed, after tax dollars that were available. So obviously, when you start to get an employee a K1, they're going to have some tax due on that K1 income. So you got to think about the tax impact of that. But the net after tax dollars available helped service that debt. So they had already started that process, and our first task was really to identify the issues they needed to address and assess the overall situation to help them exit the business. And the first, by the way, the other thing I failed to mention here was that a union contractor, and the unfunded pension obligation is always an issue you have to think about. If the business is valued, the valuation professional will consider the impact of that on the value. I've found that to be less of an issue than I expected it to be when we have valuations done. So, but I think it depends. Obviously, it depends on how underfunded the pension obligation is for the particular, pension fund that they are signatory to. So it's something to consider, and it's certainly a contingency that I think you just want to be open with your buyers about. So our first order of business was to transition one of the founding owners out so that the other founder could consolidate the ownership. And we were able to do that, and that process probably took, a year or two. And then the second order of business was to sell to the 3 key employees the rest of the stock. And that was really a tussle. It took quite a bit of time. There was a lot of back and forth. There was, there was a time when it looked like it wasn't going to happen because they could not come to terms on the valuation and all the different terms of payment and so forth. So after about 2 years of negotiation between the management team and the new majority owner, they finally came to terms. And so process all told took about 5 years. Now there was several steps here. There was some stock, that was sold to the minority owners. There was a purchase of one of the 2 founding owners, and then there was the transition to, the remainder majority stock to the next generation of owners. So But the point here is it takes time, and it takes time because, you know, everyone needs to prepare, not the least of which is the buyer. The buyer team needs to prepare themselves for the risk, the financial obligation, and so forth. So key employees was one of the issues that we want to cover, and I would tell you that this is the number one issue for me, as a general rule. And you know, do we have key employees that are increasing the value of the business, right? How do they do that? Well, they have customer relationships. They're, you know, improving systems internally to increase profitability. They're providing some organizational leadership, you know, and they're innovative and they're futuristic, and they, you know, use technology better than some of us. And so they're really taking us into the next, you know, next phase of our industry, if you will. So when we have key employees creating long-term value, and possibly they, you know, have an interest in ownership, or they're entrepreneurial, you know, their first, you know, pushback is, I'm only increasing the value of stock or the value of the business that I'm eventually going to buy. And there's a fairness perception there that they don't believe that that's fair. And so now that's, you know, debatable, obviously, because as a business owner that has owned a business for a long time, and, you know, a lot of sweat equity, a lot of risk, a lot of capital, we as business owners see that as a great value, and so these are normal debates, right? But it doesn't change the fact that we need these key employees, and they are highly sought after in today's market, and can probably find, if they're valuable to us, somebody else will value them more. And so we have to retain them, especially when we're close to the finish line of exiting the business. The last thing you want to do is be 2 years away from retirement and, you know, have one of your key people come in and tell you that they're, you know, going out on their own, or they're going to a competitor, because now that, you know, changes the plan quite a bit, and potentially reduces the value of the business. So, you know, one of the solutions we see work is, you know, compensation that somehow allows them to share in the growth of value, while at the same time it helps us achieve some retention security, right? And that can be, you know, phantom stock. It can be deferred compensation. It can be stock compensation, right? It can be all those things. Let's flip over to the next page here, and I'll go through a couple of case study examples. And this first one is really deferred compensation. And so what does that mean? Well, it means that we pay them well. We pay them market or above market for their work, especially if they're creating value for us. But we also have a deferred piece to their compensation package that is based on, you know, maybe some key financial metrics that we tie directly to the profitability of the business. Okay. So our first case study, they had 2 key employees, both under the age of 40. And the one thing that is, I have to tell you, I don't see a lot, but this particular owner had just done a marvelous job of training and mentoring these key employees. That's not to take anything away from them, because I think they're both very talented individuals, but they were ready to really run the business without this particular owner. So they developed an incentive compensation formula based on some key financial metrics. They held back, when I say held back, 40% of it was deferred. Okay, the other 60% was paid out in cash. So it was a cash bonus. It was a an incentive plan that 60% of it was paid out in cash, and the other 40% of it was deferred. The deferred amount was somewhere in the range expected to be about $30,000 a year. Okay, and then a 5-year vesting schedule was put in place. So each year they would vest 20%. The last point there is that when you do an incentive compensation, it's got to be meaningful, and meaningful is a little bit of an art. It's got to be enough that it gets their attention. A rule of thumb that I've heard and I've used is 20% of comp or more of annual comp is really a meaningful number. So, you don't want to put an incentive compensation plan in place that isn't meaningful, because then it won't achieve your retention goal, right? Because if they're going to walk away from a big number, it makes it harder for them to do that. And frankly, if you're competing for that person and they've got a deferred comp plan in place, they're going to expect you to pay them for the unvested portion. So it makes it a difficult decision for your competitor, right? If they're trying to hire one of your key people away. Now, the other question is, do you fund this or not? In this case, this particular firm decided to fund it with, and they used a insurance product called Variable Universal Life, and it's the face value of the insurance is very low, and so a lot of the premium is invested in the market, and it becomes an asset of the corporation in this case, so that it still sits on their balance sheet. It's just really moving it from cash to a investment account wrapped in an insurance product. Okay, so you're setting aside what I kind of call a sinking fund to fund the eventual payout of that liability. So the flexibility here, though, is really important, because the owner can continue the plan, or if they decide they're ready to retire and they want to offer these key employees a chance to buy all or a portion of the stock, they can accelerate the vesting on their deferred compensation, and then they can convert that to stock, and it can be kind of a down payment on their stock purchase. So there is some flexibility here to where it can just simply be a cash incentive plan, or it could be a stock plan, converted to a stock plan later. So the other thing is, there is life insurance security here, so that if something happens to one of these key people, there is an insurance component to this that can provide funding for the corporation, because again, the corporation maintains this asset, and that insurance asset, if it's needed, or if something happens to where there becomes a insurance claim, they can use the cash to obviously to fund the liability, but also to potentially fund replacing that person, and maybe even provide some additional funds to the family if that unfortunate event would happen. So, deferred comp is really something to think about. One other case study on this topic, stock compensation is another way to do this. A lot of folks don't like to do equity, and for good reason, right? Once you create a minority stockholder, there's all kinds of other issues that come along with that, buy-sell agreements, and with some fairly complex provisions dealing with, valuation of the stock should they leave, and so forth. However, on the other hand, having a minority owner that owns stock that is running the day-to-day operation is meaningful to them and meaningful to your customers. So you can use stock compensation. We've worked with one of the companies we worked with for several years, started doing that, had a young COO, about 30 years old, and we set up a plan to where if he hit certain targets each year, minimum profitability target, he would be awarded a certain amount of stock compensation, which by the way is taxable, right? I mean, you're getting something of value. So you got to think about the cash needed by that employee to cover the tax. In this case, the value of the stock was done using an adjusted book value approach. And a couple other details. The stockholder agreement was punitive if he left the company before his 10 years was up. So, and they did do some life insurance on each other to fund a potential cross-purchase obligation in the event of death. So there are some things to think about with stock, and obviously, it becomes more complicated versus a cash incentive compensation, deferred compensation. And actually, this story is continuing because now we're getting close to that 10-year period, and everything has gone well. And now we're looking at selling the other 90% of the business. So it's worked pretty well. It's retained this key employee, and it's allowed this owner to do some other things. And now we're on to phase 2. So in this case, this was a 10-year program. So each situation is different. Talk a little bit about the balance sheet. The balance sheet has to support, especially in construction, real estate, where capital and is needed to fund projects and growth. So you still have to meet your working capital needs, and if you're growing, the working capital needs are growing. The surety and the banker in a construction environment wants to make sure that you have enough working capital in place to underwrite projects. And then you've got just pure future investment, expansion, technology needs that you've got to think about. And finally, the funding of owner succession. Likely the cash is going to come from the company in some fashion, whether it's compensation or dividends or there's a redemption of stock. The cash is going to come from the company one way or the other, right? Most likely. So it puts additional strain on the company. So you have to have all of your stakeholders involved in buying into this and advising you to make sure that you are in a good position to be able to transition. And so, working capital, and then of course tax liabilities also have to be factored in. And then we a lot of times we'll talk to contractors about personal guarantees on lines of credit and surety bonds, and is the next generation of owner ready to do that from a financial wherewithal standpoint. And then finally, you got to think about downturns. So there's a sensitivity analysis that needs to be done to make sure that if there is a downturn in the construction market, that you'll be able to sustain. And a strong balance sheet is obviously important to that. Key relationships, I think is a really important area to think about early. And one of the things I think for our vendors and our subcontractors that are important to us, that take care of us, that really execute for us and make us be successful. Are they going to survive succession? If you're partnering with, you've got long-term relationships with a subcontractor, for example, that really hasn't done succession planning, that could be a real issue for you when the time comes that they exit the business because they haven't planned. Now all of a sudden, it affects your business a lot. So, I think it's important to partner with and align with vendors and subcontractors that are also interested in this planning process so that you protect one another. The surety and banking relationships go without saying. I think there has to be early communication with them. And look, the advisors and the sureties, the bankers, that they're working with other companies and they're learning about their succession planning, and they can bring that expertise just like we can. We have a lot of experience with this. We've seen a lot of different things, and so it's important to really, reach out to those key advisors and get their advice, and do it early, and it allows you to think about what makes sense for you in your planning process. Customers, that this deals a little bit with that end market from the CFMA slide. Do you have the relationship, or do your key employee, does the organization, the institution hold that relationship? And if you have a relationship with certain key customers, you got to start transitioning those relationships. And many times we're, as the owner that's retiring, the relationship probably is with somebody similar in age. So we take our younger up and coming project managers and VPs, and we obviously align them with their next generation of management team, and that works fairly well. And then your customer base, is it one that is growing, financially stable, or is it in industries that are threatened by tariffs or other market forces? So really important to look at your customer relationships. And then, are you too reliant on any one relationship? And is that really a concentration risk that you should address long term? Financial reporting that's accurate and meaningful, not only your CPA prepared financial statements, but internal reporting is sometimes something that's not talked about enough. A lot of times we'll get into a planning process with a company, and they've really just worried about their tax return from a reporting standpoint, and they've built up a nice business and equity, and they really don't necessarily have a lot of external users. And so bringing that financial reporting to a meaningful place to where evaluation can be done, where an independent CPA can advise potential buyers on the value, on structure, on cash flow, becomes an exercise. So I think it's important that you focus on internal financial statements. I always tell folks it's really a credibility issue to have good internal and external financial reporting. It sends a message to the marketplace, and maybe that's just an internal marketplace, really your employees that are ultimately the buyer of the business. But I think it's an important investment to make. And lastly, do you have the business valued periodically? If you're in an industry that is growing or declining, and the valuation is moving potentially in the wrong direction, I think that's important information for you to evaluate in terms of your timing. Investing in the future, the only thing I would say in general about this is you got to keep investing in upgrading your equipment and your technology. Many times we see businesses get close to retirement, and they defer making any capital expenditures to try to improve the overall appearance of the business, instead of having a lot of equipment or hard assets, sunk costs in those. And sometimes that can be a liability, right? Because the buyer will come in and have to make investments in that business, and they will discount the value of that business because of that. So I sort of discourage against that. So contingency planning is really, like I said, probably low-hanging fruit. And one of the things that we see a lot of times, most businesses don't really have a contingency plan in place that's documented. In this case, 80% from this particular survey did not have a documented, either they didn't have one at all or it wasn't documented. And a contingency plan is, if something happens, who does what, and where are the passwords stored. But think about if something happens to one of your key people or yourself as the business owner, what does that next step look like, and making sure that you've addressed all of the potential issues that could come about from either a death, a disability, or maybe a natural disaster that need to be addressed. So it's an important part of your disaster recovery plan. The other area that we see far too often is that when there are multiple owners, there's really no updated or none at all in terms of a buy-sell agreement, and all that does is expose the current or future owners to disagreement. So buy-sell agreements, cross-purchase agreements, different terms for the stockholder agreement we see absolutely critical, because if something happens to your co-owner or partner, you're going to be negotiating that with someone other than them, right? Because their family is now going to step in most likely. So in this case, 2/3 of the respondents to this particular survey, small businesses, did not have a updated one in the last 3 years. So, excuse me. So all key agreements need to be up to date, and it's kind of one of those corporate due diligence things you need to go through. Related party transactions for sure, make sure those are documented. Buy-sell agreements we talked about, and then is there funding in place to fund buy-sell agreements? And lastly, talk a little bit about have you considered entity and structure and tax implications of a potential sale? I do want to focus briefly on utility contractor that we worked with that did have a concentration issue. I think that you'll see this, we do see this more often than not, where they have a very significant relationship. A lot of times, that becomes a real valuation issue for contractors, where their relationship, or a lot of their volume, is coming from one customer. In that case, I will tell you, it's probably, in this case, is no different. You're going to find that the buyer is probably going to be an outside strategic or financial buyer that's interested in that larger relationship. Talk about tax planning a little bit. I think the entity structure, the new tax law from 17, probably even enhanced the need to do planning, because C corporation rates went down. The opportunity zone laws came into place, and so there could be a 35% spread between planning and not planning, right? Because if we can get our taxable gain into a cap gains rate versus the highest combined rate of probably 50%, when you consider state and federal tax rates, it's a pretty big spread. Most of the time, what we see is a 10 to 20% savings by doing appropriate planning. So 35% is really on the outside. Lastly, I want to cover, who the most likely successor is, and you can see from this chart that in the construction industry, management buyout, and then the far right, transition to the next generation, that gets us up to 70%. And then ESOPs, are somewhat prevalent in the construction industry. Unlikely, financial buyer would be a buyer, partial sale is unlikely, and then a strategic buyer is on par with ESOP. But most of the time we see what we call an internal transition. Real estate industry, transition to family member, almost 2/3, and then by nature of the asset, financial buyers like private equity firms tend to be somewhat interested buyers. So 1 out of 4 of those in this particular survey. So talk lastly about ESOPs, and then we'll take a couple questions. It is a qualified retirement plan. There are significant tax savings, especially in a C Corp environment. There are some general rules of thumb. there's got to be 20 employees probably as a rule of thumb, not absolute. $1 million a year of eligible payroll. So there is a certain size you need to be to even think about it. ESOPs are setup costs 80 to 250,000. That's a big range. If you compare that to selling the business outright and paying an investment banker, it's not an unreasonable amount of money. But just know that there are some costs involved in setting them up, and then ongoing, you've got some fees, you got to have a valuation done, and some administrative costs around administering the plan. So the one thing I always point out to folks is when an ESOP is now a stockholder and owns either anywhere from 0 to 100% of the company, it's a permanent liability, because you will continually recycle those shares inside the ESOP as new employees start work and other employees that are participants in ESOP retire. So it's a permanent liability that you will continue to have to fund. And again, those funds, there are some tax benefits, but those funds do come from the company. It does help the business remain locally owned and operated, so I think it's a great alternative. Many studies have proven that ESOP ownership has improved overall business performance. It does not address leadership succession. It's really a ownership succession, so we still have to worry about who's going to run the business. And a lot of times there is some leverage on an ESOP loan from the bank. Remember that an ESOP value can fluctuate annually, so that can become a real morale killer when you're in difficult times. The value goes down and somebody's close to retirement. So those are all things you just have to manage. So wrapping up here, why are so many business owners delaying the business succession process? And these are not supposed to add up to 100%. These are just different reasons. Most folks delay because they really don't have an immediate plan to exit, right? And that's where I go back to time. You need time to do it. And then, day-to-day operations and other priorities are more pressing. So it's not a priority, 53% of the owners. And the last one is, and we see this a lot, it's very, very difficult. You avoid making difficult decisions. A lot of times happens in a family business. It's just hard. And so these are, the last one is really, that's a real, delayer, and we've got to really overcome that. So in the middle one, priority, you just got to make this a priority. And I would say, even though you don't have immediate plans to retire or exit the business, sometimes that's out of your control, right? Sometimes it's out of your control. So so what are the next steps? Well, I think you got to assess where you're at, looking at your agreements, looking at what we do is we really de-risk the business, right? We try to identify where we have risk, where we can enhance and protect value. So, meet with a key advisor to do an overall assessment, or an advisory team. And then you, again, assemble the team to address those needs, right? Set a timeline, right? Establish a goal. And then you got to consistently review the plan and adjust it annually, because the market changes, key employees change, and so forth. And that concludes our presentation. At Sikich, we have two partners, myself and Ray Lampner, that are the co-leaders of this particular service area. Ray's in the Akron office, and I'm in the Indianapolis office. And if you would like to, talk to either one of us about your specific situation, we'd be glad to visit with you and give you our initial thoughts. So with that, I'd accept any questions if anybody's got any questions. Well, one question that we received is there a business too small to do succession planning with? And my answer to that is there really isn't, because we work with small and large businesses. Obviously, some of the examples we gave you, but if you're looking to protect the asset, and I sometimes will use the analogy of, when we sell our home, we may hire an advisor to help us sell the home to get maximum value. And I guess I would say that what we try to do is identify and help you plan for how to maximize your value. And sometimes it's simple tax planning, and other times it's trying to shore up where we see some of the risks are. So there really isn't a business that's too small. So anybody else have any questions? Okay, well, I think there's some attachments that our staff has provided to you today, and if you and there's actually a survey that we'd ask that you fill out, and you certainly can reach out to me or to Ray. I think our copy of the slide presentation is one of the things provided, and our information's in there. Thank you all for joining, and have a great rest of your day.